After 2 brutal weeks, we finally saw a strong rebound. But the big question now is this rally for real, or is it just another chance to reduce exposure? Let's break it down. Hi everyone! Welcome to another episode of Intelligent Investing. I'm April Tan. After a steep sell-off in the first half of November, the PSEi surged 7.4% to close at 5,997.13, slightly higher than its end October level. Market breadth finally turned positive, with 161 gainers versus 101 losers, and foreign investors bought 3.1 billion pesos worth of shares. The rebound was led by banks and property stocks, which had been among the hardest hit earlier in the month. The big three banks, BDO, BPI, and Metrobank rallied 10.5%, 14.1%, and 8.9% respectively, while large-cap property names SM Prime and Ayala Land climbed 18.2% and 11.7% respectively. Converge also surged 18.7% as it played catch-up with PLDT and Globe, which had already rebounded strongly the previous week. Plus rose 11.1% after subscribing to 12 billion pesos in convertible notes issued by International Entertainment Corporation or IEC, the owner of New Coast Manila Hotel. The notes give Plus the option to acquire up to 53.89% of IEC. We view this deal positively. A land-based casino would complement Plus' online gaming platform, deepen customer loyalty, and diversify revenues away from the more politically vulnerable online segment. The deal could even be self-liquidating. Once Plus operates a land-based casino, its franchise fee for e-casino games would drop from 30% to 22%, potentially saving about 5 billion pesos annually and allowing the investment to be recouped in under 3 years. FGen gained 4% after completing the sale of 60% of its gas platform to Prime Infrastructure for 50 billion pesos. While the divestment will sharply reduce earnings next year, as the gas platform contributed about 65% of profits in the first 9 months, we still view the deal as value accretive. Earnings from the platform were already expected to decline as some Meralco contracts near expiry, and the sale price is roughly 25% above our NAV estimate. We estimate FGen's NAV will rise 6.3% to 34.17 pesos per share. The key question now is how FGen will use the 50 billion pesos in proceeds. With the parent already in a net cash position, it isn't pressured to repay debts, leaving room for potential special dividends or future acquisitions in renewable energy. Manila Water rose 8.2% after its subsidiary, Manila Water Asia Pacific, agreed to acquire a 74.85% stake in Mexican water operator Agua de Puebla for roughly 11.6 billion pesos. Meanwhile, CNPF was the only index name that declined, slipping 0.5% despite favorable trade news. A new executive order from U.S. President Trump exempted most Philippine agricultural exports, such as coconuts, fruit juices, processed pineapples, bananas, tuna fillets, and dried fruits from the 19% U.S. reciprocal tariff. This benefits exporters like CNPF, DNL, and Axelum. Axelum rose 6.6% during the week, while DNL was flat.
Has the market finally bottomed, or is the rally simply a selling opportunity?
I think the answer to that question depends on your investment time horizon. If you're a short-term investor, I think this bounce is a selling opportunity. For traders, we see this rebound as an opportunity to lighten positions, as the fundamentals simply don't justify a sustainable rally yet. Earlier this month, we talked about how 3Q GDP growth was just 4%, far below expectations due to government spending plunging because of the corruption probe. Household consumption growing by only 4.1%, its weakest since early 2021. Corporate earnings also reflecting the slowdown, as most companies missed analyst expectations with median profit growth at only below 5%. Weak performance was apparent across telcos, consumer companies, power companies, and gaming companies. All of this is not the backdrop for a durable market uptrend. Lastly, there is growing AI bubble concerns. So even the US tech rally is showing signs of cracking. Big tech is still pouring hundreds of billions into AI, but commercial returns remain limited. A recent MIT study found that 95% of firms saw no measurable gains from AI, and OpenAI posted $7.8 billion in losses in the first half of 2025, which is higher than last year's losses despite strong revenue growth. At the same time, the S&P 500 is trading well above historical valuations, and the Magnificent Seven now make up 40% of the index, making markets highly vulnerable to any shift in sentiment. We're already seeing hints of this. Last week, both the S&P and the Nasdaq fell substantially, even though Nvidia beat earnings and its CEO insisted there is no AI bubble. Last week, we released our latest Calling the Shots report. Given the weaker macro backdrop, we recommended shifting exposure from SM to MYNLD. Why, you may ask? SM Retail's 3Q numbers were weak. Profits were down 27% and revenues were flat as demand was negatively affected by poor weather conditions and the shift in the start of the school year. Margins were also hit by negative operating leverage and greater discounting. These pressures may continue in a soft economy. In contrast, like we mentioned last week, MYNLD offers defensiveness. Water demand is stable across cycles, and the company earns a regulated 12% return on its approved investments under a concession that runs until 2047. At 15.46 pesos per share, the stock offers a 6.8% projected dividend yield and a 24.8% upside to our fair value estimate of 19.30 per share. A correction in U.S. stock market would likely spill over to emerging markets, including the Philippines. That's why traders should view this bounce as a chance to reduce exposure. However, if you are a long-term investor, buying stocks for your retirement or to pass on to your children, there's no need to panic. Warren Buffett famously said, "Be fearful when others are greedy, be greedy when others are fearful." While U.S. stocks are trading at lofty valuations, which should make you fearful, the PSEi forward PE is just 8.8 times, near global financial crisis lows. Many blue chips are also trading at 10-year lows, despite profits being much higher today than they were then. Several companies also offer dividend yields that are above government bonds.
Even if companies are earning well, how come their stocks aren't doing well?
If I look at the list of stocks that are trading below their 10-year level, it's not even PE, it's absolute value. Meaning their stock price 10 years ago is even higher than the stock price today. First of all, if you look at their earnings growth, it's up, but it's up by mid-single-digit levels. Although it's higher, it's not exciting. Second, if you think about the property sector, for example, there have been a lot of threats facing the property sector over the past 10 years. Office sector bubble, because they overbuilt due to the POGOs, which left. Therefore, there is an oversupply there. And then now, residential oversupply. And then, of course, we had the pandemic which hit the malls. So people are always worried about risk. People have just become risk averse as far as those sectors are concerned. So I think it's a combination of those two. And then, of course, if we look at the earnings of consumers, they were hit by lower margins and higher costs. So maybe that's why their share prices aren't going up despite earnings being higher today. Lastly, for long-term investors, this is not the time to be fearful, but to be greedy. But remember, position sizing is everything. That means avoid leverage or buying stocks on margin. Only invest long-term funds that you are sure you won't need anytime soon. And finally, also consider keeping some cash or dry powder ready, as liquidity will allow you to take advantage of irrational sell-offs if the global contagion hits. In uncertain markets, stability and predictability matter. So is the rally the start of a recovery or just a breather? For traders, this is a good time to take profits, but long-term investors can take comfort in exceptionally cheap valuations and attractive dividend opportunities. That's it for this week's episode. If you found this market wrap helpful, don't forget to like, subscribe, and share this video so you're first to know what's moving the market. Once again, I'm April Tan. Remember to stay sharp, stay selective, and as always, invest intelligently.